What's up, everybody? It's your boy Sad coming to you with today's stock pick, indicator help, and general investment tips. Remember, this channel is all about no face, just facts in 5. I do the research so you don't have to. Shout out to 11 Labs for making every video possible with their next-gen voice cloning and text-to-speech tools. Link in the description and profile. Let's dive in. Today we are breaking down a massive paradox in the tech sector. The software giant Oracle, trading under the ticker ORCL on the New York Stock Exchange, just dropped its fourth quarter earnings report. By all standard measures, the company absolutely knocked it out of the park. Yet, despite delivering record numbers, the stock experienced an immediate sell-off, dropping down to the $201 mark. Is this sudden drop a perfect buy-the-dip opportunity driven by institutional profit-taking? Or are investors waking up to hidden structural risks behind the massive artificial intelligence build-out? To understand why Oracle is a critical player, we must look at what their business actually provides. Oracle is an absolute powerhouse in database software and cloud infrastructure. In plain English, they build the massive digital storage vaults and cloud networks where global corporations and artificial intelligence platforms store their data. Their cloud infrastructure business has become a major driver of modern growth. In this latest quarter, cloud revenue soared by 93% to nearly $5 billion, proving that major organizations are aggressively migrating to Oracle. Let us dive into the raw earnings numbers because they are spectacular. Oracle reported total quarterly revenue of $19.18 billion, narrowly beating estimates. Their adjusted profit came in at $2.11 per share, completely crushing the analyst expectation of $1.96. Even more impressive is their remaining performance obligations, which represents future contracted revenue. This backlog exploded by 363% to a historic $638 billion, driven by artificial intelligence contracts. Moving over to the daily stock chart, the price action shows a near-term cooling off period after an immense run. Just a week ago, Oracle was flying high near its peak of $248 per share. This recent drop to $201 represents a sharp correction. The stock has broken below its short-term moving average, meaning near-term sellers are temporarily in control. However, trading volume has exploded, clearing over 40 million shares today, proving that major institutional desks are actively trading this zone. Isolating the momentum indicators gives us a clean look at the exact data story playing out right now. The 14-day RSI has dropped sharply from overextended levels and is currently sitting in the high 30s, showing that the stock is heavily beaten down and approaching oversold territory. At the same time, the price action is sliding right along the lower rail of its Bollinger Bands, showing that the downward move has been stretched to its limits. Meanwhile, the MACD tool is sitting below the zero line, but the red bars on the MACD histogram are beginning to flatten, showing the downward speed is losing power. Let us outline the critical price boundaries you need to watch right now. Your immediate overhead technical resistance level is sitting right at $212. If buyers can push through the initial panic and force a close above 212, it unblocks the chart for a run back toward the 248 targets. On the flip side, if sellers keep pressing, your primary safety floor and major support zone is resting firmly at $198, which is your clear line in the sand. We must have an honest conversation about risks because even giant tech companies carry hidden warnings. The main reason the stock dropped despite the great earnings beat boils down to investor worries over debt-fueled capital spending. Oracle announced plans to raise $40 billion in debt and equity financing to fund their data center build-out. Wall Street is growing nervous about the immense costs required to build these facilities before they generate consistent profit. From a strategic standpoint, this setup is a classic momentum play at a vital crossroads. The underlying business growth is undeniable, and their future contract backlog is massive. The smart play here is to add Oracle to your watch list and watch how the price handles the $198 support zone. Wait for the MACD histogram bars to begin shrinking to confirm that selling pressure has dried up, keeping your position sizing tightly controlled while this infrastructure story plays out. Remember, I'm not a financial advisor, and this is not financial advice. Always do your own research before investing. If you found value in today's video, hit that like button, subscribe, and share it with someone who's just beginning their investing journey. This is Sat with Stocks by Sat06. No face, just facts in 5. Keep learning, keep investing, keep building. Peace.